Welcome to Market Monday from the investment team and the trust department at the First National Bank. Today we're going to start like we usually do with the economic review, what's on deck over the next couple of weeks and how they might impact markets, these economic reports that are coming and expected. We'll go into markets, what's moving them, and then we're going to close with, or maybe get to before we close, with a discussion of the events going on in the Middle East and implications for the global macro regime, which has definitively changed in a massive fashion over the past few years. And recent events year to date have just borne that out. Speaking to a more volatile, higher interest rate environment, higher inflation environment for the foreseeable future. So kicking things off, leading economic indicators are expected today with showing a slight decline if the survey is correct. This one's really hard to call. We've been getting conflicting data, most of which says the economy is actually relatively robust, some of which might argue in the opposite direction, but overall, these numbers are not meaningful in any major sense. This does tend to be obviously a leading indicator of where the economy is going, but quite frankly, this thing has been negative for a very long duration of time. And the economy has still been growing in a relatively robust fashion, if not overly robust fashion, that's inflationary. So we're not putting as much stock in this as we maybe used to. We get labor market information. We're going to get outlook information with the Purchasing Managers Index. Durable goods orders is a big one. That gives us insight into the health of the manufacturing sector and big ticket items. And consumers are not buying big ticket items unless they feel relatively confident about the economy. So this change from a 4.5% decline in the prior period to be revised up to, or updated to 1.3% growth in those orders would suggest some stabilization of demand and less reason to worry about the economy. Wholesale inventories and retail inventories are great when looking at together. You want to look at these together because it gives you an idea of what's happening. So our wholesale inventory is growing while retail inventories are shrinking. In other words, retailers are buying less goods because they forecast less sales. That would be bad for the economy, and that would be kind of bearish for overall market performance expectations. Whereas on the other hand, if retail inventories are swelling because they see a big boom coming in consumer spending at their locations or their businesses, and the wholesale inventories are drawing down, that suggests that there's not enough supply to keep up with demand, and would suggest that overall economic activity is likely to be robust in the near future. Therefore, earnings. Going in, we'll get information about consumer confidence. That's a hugely important number because consumer confidence is 2/3 of GDP growth, or thereabouts. And as we get into later, we'll get the Federal Open Market Committee's rate decision. And this is expected to be nothing. They're expected to stand pat, despite the fact, as we're going to cover here shortly, almost immediately, that inflation is a bit out of control. The spin that everybody's putting on this from the podium politically or, from the Fed has been, we expect this thing to calm down. And that's very, very much echoing the kind of stuff we were hearing in 2021 and 2022 about inflation being, quote unquote, transitory. And we get a little bit nervous when we hear things like that because we don't think the facts bear out that this looks transitory. Moving into things, we'll get income and spending. Those give us some insight as well, both on the economy and economic activity, and thereby, flowing through to corporate earnings, but also give us some insight into what are the inflationary pressures, because wage inflation is something that's considered, quote unquote, sticky. In other words, it's tough to reverse, whereas other types of inflation might be easier for monetary policymakers to deal with. The last period's growth was 0.7%, and we're expected to see a 0.3% rise. So that's a deceleration, but that's not, negative. That's not reading out that consumers are getting stressed necessarily at this point, but is another number that's worth watching. Here we're going to get later, also after that, the core PCE price index, which everybody seems to be jumping for joy that indications of inflation have come down closer to 3% rather than 3.5%, 4% over the past, month or two. And we're not so convinced of two things. Number one, that deceleration in inflation is a durable deceleration. and that this isn't necessarily a good thing. When the Fed's official target rate for inflation is 2%, is a 3.3% core PCE really good? That's 50% higher, a little bit over 50% higher. We'd argue the grade for that is at best a D, maybe a C minus in terms of managing inflation from the Federal Reserve. So we're watching this kind of carefully, and we don't believe, like a lot of the talking heads are saying, that we're out of the woods with respect to inflation. And we get more information about GDP growth. That's expected to show a slight increase, and then more sentiment information rounds out the week. And now, before we go forward into markets, which we're about to do, I want to pull up this world interest rate probability screen shows basically based on derivatives positioning where large traders aggregately think the odds are that the Fed's going to hike or cut rates, and by how much you can gauge. So as you can see here for the July meeting, a non-trivial but non-significant at the same time percentage chance of a hike, and that would be 15.5% chance of a one hike. In other words, 25 basis point. But we get a big jump in probability for the September meeting, and you can see that the market participants are positioned such that it's very likely that this is going to happen by September. We would argue this should have happened months ago, though. And moving right along, we're going to start not with the market. We're going to start with oil. So this is West Texas crude, and you can see very clearly that we had this so-called memorandum of understanding come out that dropped oil prices from above 90 to just below 70 over the course of a little, maybe a month-ish. And then with the widely expected, did anybody really expect this so-called memorandum of understanding to hold? It was very weak in language, very ambiguous, and we have major hostilities over there with major players that have major reasons for continuing to hold their own line. So we were not surprised when there was a return to hostilities that now have spiked oil back above into the mid 80s. And it's coming down this morning on some news that crossed the wire of an alleged peace, brokered peace treaty or period, ceasefire with some of our mediators. And, quite frankly, we're looking at all of this not through the rose-colored glasses that the media seems to, or that even the markets seem to. Every time there's a bit of news, there's a decline in price on news that there might be a truce. In a conflict that's thousands of years old, really, if you look at the continuous timeline. So instead, we're kind of watching this. We expect that the hostilities are likely to continue for the indefinite future. This was our base case, not all-out war, not complete peace, but something in between, a smoldering conflict that has periods of exacerbation and periods of relative quiet. And we're seeing that bear out. So what are the implications for that for the wider world? We're looking at a period that is much more akin to the 1970s than we are the 1990s or the aughts or the teens. And the reason is globalization, which was the disinflationary foundation that was underpinning the whole global macroeconomic structure, so to speak, has abruptly reversed course. And now we're seeing protectionism, essentially a form of modern mercantilism, characterized by high tariffs, everybody going in on their own, old alliances that were very strong under the globalist ideals, fraying or, being completely dismantled and replaced by something new. What's important is when every individual trade bloc that's out there has their own complete need for a supply chain that's independent of all others, that's an inflationary pressure, and that's what we have for the foreseeable future. That is not a minor change in the structure of global geopolitical positioning. And so as we're looking at oil being higher, we can take this thing back 5 years and let's see. Yeah. And it was much lower. It was in the 60s or even in the 50s. But structurally, we don't see a return to that. We see a return more of this 70 to 100 area. And if hostilities go worse, last week at one point, we and the United States, in other words, bombed a lot of bridges around the Card Island complex or nearby to it that would suggest that we might be considering military action to take that island. And if we do, oil prices could be forecasted to rise sharply in the interim. Same thing with the Iranian threat to close down other means of passage for tankers. It's just that there's an environment that leads to potentially higher shipping costs and or just outright raw energy prices. And, we're looking at fixed income here. The rates are pretty good. This is on the treasuries. You got a 5-year treasury at 4.3. You got a 30-year over 5%. 5.08%, by the way, is relatively high by recent standards on the long bond. And that suggests, again, inflationary pressure. When you see rising rates in maturities 10 years and out, that's mainly a reflection of the inflation expectations of large market participants. So we're watching that. That's a level that's relatively unseen in the recent history. And when we look at the corporate yields, if you're an investor with the 60-40 portfolio, you're using bonds to hedge your equity market risks and also potentially live off the coupon payments from those bonds to some extent or fund cash flows from them. A 4.8% 5-year paper, 5.32% 10-year, and if you go out further, we're getting close to 6. This is relatively good, because the addition of bonds to a portfolio of stocks dramatically reduces the volatility of the portfolio, and at the same time, it's paying you decent yields. Going back to markets, what are we seeing? Well, this sort of pattern here suggests that the market doesn't know what to do, can't get really meaningfully above anyway, 7,600 in the S&P, or below this 7,200 and change area. And technicians would call this a period of consolidation. And for all intents and purposes, it just means the market's treading water, waiting for the next big catalyst. And we're highly suspicious that the next big catalyst will be as these events over in the Middle East and or Europe with respect to the Ukraine war unfold. Are we worried about potential for dips? Yeah, I think going into the fall, September and October historically have the highest probability of major market events. We have stocks going up on a lot of hype, and then we had all of the technology stocks, or the main technology stocks pushing the market higher, go into essentially a 20% correction, officially noted as a bear market over the past few weeks, as steam is getting let out of that AI trade. Now, is it over? I don't know. Nobody knows. Alan Greenspan, who was one of the great Fed chairmen, said in 1996 that the market was full of irrational exuberance during the internet bubble. And that continued on until March of 2000. So we don't know when precisely that's going to end. Growth markets, momentum markets like that tend to be volatile. So a 20% correction could still be viable as a long-term uptrend holds, depending on, what happens as this thing continues to unfold. We're not really worried about any of that, though, because we're long-term investors. And if we zoom out over this 20-year period, you can see what would have happened if, say, during 2008, you got scared and sold all your stocks and then never bothered to get back in because you were afraid for a number of years. You would have missed out on a tremendous amount of growth. And at the same time, you would have locked in losses. And so we want to avoid doing things like that. That said, we've been getting some inquiries lately about people that want to go all in on the market and buy the index. And when you buy the index's risk as well. And, just as dangerous as turning around and selling into panics like in 2020, 2008, the 2018, the 2022 bear market. If you do those mistakes are costly, but it's just as costly to buy into a mania as it is to sell into a panic. And with that mania having happened in the AI stocks and in the tech stocks, chips in particular, it's not advisable to sell your bonds and buy stocks. It's not advisable to sell your defensive positions and go well into technology. What we're trying to do here is achieve financial goals, not necessarily beat the market or ride the market to get its return. You have financial goals that are important, and they're part of your well played or well laid out financial plan that you and your professional have presumably worked out. So if you have questions about all of these things, how the market is moving, what are the implications of the global macroeconomic environment, why we shouldn't be buying manias or selling panics, any of this stuff, feel free to give us a call. We love talking about it. Hope you found the video useful. Thanks and have a great day.